Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially with these tariffs now being delayed 30 days. What does it mean for the Canadian and US trade conversation, these negotiations? What does it mean for the Canadian economy if we see these tariffs come into effect? And more importantly, what will it do to fixed rate and variable rate mortgages as we get into February next month? We're going to see the Bank of Canada at its next press conference. Will they end up cutting rates again? Want to unpack our thoughts and opinions this week, so welcome back to the channel. Once again, if you have not subscribed to the channel, please consider subscribing. Don't forget to hit the like and share button if you've picked up on something interesting this week. More importantly, let me know your thoughts, questions, and concerns in the comment section below. I want to hear from all our viewers, especially as we enter into this negotiation talks with the United States, getting these tariffs pushed an additional 30 days. As we saw, complete pandemonium over the weekend. Obviously, a lot of our politicians, we saw our Prime Minister negotiating on Monday, obviously sending alarm bells to the Canadian economy. We saw Doug Ford trying to pull stuff off the shelves, canceling contracts with Elon Musk and Starlink. Obviously, all this has been pushed to the wayside. The actual threat of these tariffs still remains real. And the real question is are we going to see 25% tariffs on all goods? Are we going to see 10% on energy? This is really the question as we also grapple, or the United States also grapples with trade wars with China. Now, it's important to understand a few items as a backdrop to this whole scenario. And ultimately, I want to share my thoughts and opinions. I believe that Donald Trump is going to be exercising and using the leverage he has as the president of the United States, the strongest and largest economy in the world, to get what he wants at the negotiating tables, especially the fact that we have a very weak government right here in Canada right now, with the Liberals facing basically a election in the next little while once they appoint their new talking head, and then ultimately who will be replacing. Will the Liberals end up winning? Will the Conservatives end up winning? And that literally leaves the door open for potentially further talks down the road. We saw Mexico get the first extension Monday. Later that afternoon, we heard that also Canada got it. 30 days, ultimately great talks, as the Prime Minister has mentioned. But the fact is that I believe that these tariffs will still come into effect, maybe not in the same format. We may not see 25% tariffs on all goods that are entering the United States from Canada. We may see a smaller amount. We may see 5 or 10% tariffs on certain items. Once again, there's a lot of uncertainty. We don't know if there's going to be any exclusions, any talks about particular items. Once again, will Canada retaliate with the exact same tariffs on those items coming into Canada? Regardless, as there's a lot of uncertainty here, we don't know what will happen. The fact is that any type of tariff, any type of indication that there's going to be a higher cost to goods entering Canada and leaving Canada leaves the reality of potential job losses, increased inflation, obviously weaker economic growth, things that the Bank of Canada is obviously looking at. I mean, the Bank of Canada, we talked about last week, predicting and modeling a 1.8% increase in GDP, gross domestic product. Basically means the economy might grow less than 2%, but if we see these tariffs, it may contract. It actually may go negative depending on the size of these tariffs. All that to say that the Bank of Canada will have to be prepared to make a move. The question is, will they make the move as many have formulated? Will they start cutting rates? Will they have to cut rates? That is really the question. I think a lot of economists believe that the Bank of Canada may have to move the needle to cut rates in order to compete with a weakening dollar, obviously weaker GDP, growth in the economy, productivity. So a lot of Canadians, as we look at this information, I mean, especially filming this on Wednesday afternoon for our Friday release of our Finance Fridays, a lot can happen in this time frame. And as I said, the best way to approach this is with a little bit of uncertainty, especially for Canadians making a decision when it comes to their mortgage. I know a lot of clients I'm working with right now are approaching mortgage renewal, closing their mortgage transactions by the end of February. So there's not really a clear line of sight on what to do next. Remember, as we look at all this happening right now, we hear and see a lot of conversations, a lot of analysts from banks like BMO talking about potentially 6 cuts coming down the pipeline if we see a 25% tariff. What happens if we don't see a 25% tariff? What if this actual tariff does increase inflation, but because we know what these costs and where the cost will be directed to can actually help us understand where inflation's headed, and meaning that it could be transitory, right? Truly, in this case, I believe the word transitory is the right word. Not like we saw back in 2021 when we had the signs of inflation creeping back up, but the central banks believed it was transitory, especially with supply chain issues, yada, yada, yada. That time, completely different conversation. This time around, we know if there's a tariff on a specific goods like produce, coming in from the US, how long will that last? Now, with the fact that, hey, yes, Canada can import items from South America. Certain fruits and vegetables can come from other countries and have to come from the US, but there's certain items that the US produces that we can't get from other countries. So this is super, super important, as this trade conversation will impact 100% both sides of the border. Maybe not equally, but it will impact both Americans and Canadians. I do think that, as I mentioned in the past, if history is our guide, that they will come to some reasonable conversation, some reasonable negotiations, just as they did in the previous Trump presidency, right? So this is super important. Now, once again, getting into the Bank of Canada, we talked about last week, they cut 0.25%, bringing that overnight lending rate to 3%. A lot of banks like BMO saying, hey, it's going to go down to 1.5. Some banks saying, no, it's not going to go that low. We can't afford for it to go that low, because ultimately we know what happens when we actually produce cheaper money, right? Borrowing costs ultimately may favor Canadians that are highly levered. But at the end of the day, what will the Canadian economy do? How will the Canadian economy react, I should be saying? And literally, how will that translate to the Bank of Canada's next decision? I believe the jury's still out. The Bank of Canada did not really give Canadians guidance last week to say, hey, if this, then that, meaning if we see these tariffs, this is what we're going to do. Really no conversation about that, just really hypotheticals, really just some theories. At the end of the day, when the Canadian economy does contract, if they do have the runway to actually continue to reduce their policy rate, they may use that as a tool. Once again, they have to also combat a weakening Canadian dollar. So many different components in the bucket. And obviously, as we know, fixed and variable rate mortgages move on different ends of the spectrum, right? One is the Bank of Canada, obviously the policy rate, which impacts directly variable rate mortgages pretty much instantaneously, right? We'll see the Bank of Canada reduce their policy rate. Most banks will adjust their prime rate to reflect that recent cut, whether it be 0.25%. Obviously, prime has now moved to 5.20%, and that ultimately loosely based on the economy and where the economy is headed. Now, on the other side, we have bonds. We have basically fixed rate mortgages that are impacted by bonds. And looking at those 3 and 5 year bonds, we've definitely seen them fall off a cliff over the last couple of days, with all these fears of these tariffs and what it could mean for the Canadian economy. Now, obviously, these are good opportunities right now. Some banks have adjusted their fixed rate mortgages, mostly for those high ratio default insured mortgages. So those Canadians buying with less than 20% down, those that are paying the default insurance premium, are going to actually get a slightly better rate. We have seen some adjustment right now in some of those fixed rate mortgages, but as we see this time change, right, as we see the economy evolve, as we see things sort of play out, the bonds may move back up, right? We may see those bond yields move higher, basically triggering the banks to maybe not adjust their rates, maybe increase their rates back to where they were just a few weeks ago. For example, not saying that that's the case. As I said, right now, some of our banks have not adjusted. They're waiting for more sustainability, right? They're looking for a longer runway before they start moving their rates down. No bank really likes to cut their rates and then increase their rates. It creates too much uncertainty and adds to the fuel, especially as around 1.2 million Canadians, we've talked about this before, are approaching mortgage renewal in 2025. So now with about 10 months left, we're in February. A lot of our clients that are renewing right now, that they have a renewal date set for the end of February, or closing their purchase in February or March, doesn't really give us a runway to figure out what the best strategy is. So we have to look at each case, each client individually. You have to look at your individual case, your appetite for risk, your tolerance to seeing what happens, right? A lot of Canadians with smaller mortgages may decide to take on a variable rate mortgage with a true adjustable payment, where their payment will move lock and step with the Bank of Canada's reduction in policy rate, which therefore translates into their prime lending rate. we'll see those lines of credits come down. Obviously, that is readjusting a lot of these mortgages that were previously negatively amortized. And I did touch on that last week, but I did want to provide a little bit more clarity. In the past, what was happening with these variable rate mortgages was the interest rate was going up and the payments were staying the same. So more of that money was going towards interest than towards principal. Now the opposite is happening. As these mortgages and these policy rates are coming down, more of that money is going back into principal, and it's readjusting and recalibrating those amortizations. So a lot of clients maybe want to take a variable rate mortgage, but they're looking for an adjustable, not a trigger rate static payment. Some are on an adjustable rate and they're looking for that static trigger rate mortgage. You have to understand which type of product your lender that you're working with is providing. And then ultimately, as I said, looking on the fixed end, a lot of good discounts on the 5-year, but we're not really pushing. It's not really a popular product. The 5-year fixed for most Canadians is a little bit too long of a window, an horizon to, especially in this rate environment, to lock in for 5 years, right? Not to say that it's a bad choice if you decide to exercise the 5-year because you don't like the risk, but ultimately the 3-year product is still super popular as it gives Canadians a lot of runway to figure out, hey, what happens in the next little while? Are we going to see fixed rate mortgages drop? And I'm not paying that penalty if I do want to get out a little bit earlier. Obviously, having a conversation with your mortgage professional about how these particular numbers look for your particular situation, or you can download our app in the description box below and play around with some of those useful calculators, refinance tools. Ultimately, as you're approaching renewal, knowledge is power, and it helps you make the best decision to keep thousands of dollars in your pocket. Now, the last thing I want to say, as part of this trade war conversation, obviously what Trump wants and leveraging his power is to bring American banks into Canada. Now, although his statement seems a little bit controversial, there are American banks. There are Canadian banks that operate in the U.S., have subsidiary banks, but ultimately we do have some American banks here in Canada, like Citi and JP Morgan. Although they're not as like traditional banks like we see with our top 5, to put it very simply, they don't operate the same way. We do have an older, a big monopolistic situation here with our banks. We have an oligarchy with the banks. They do hold a lot of power. There is only maybe 5, depending if you want to include some of them into that equation, but there's 5 major banks in Canada. One of them was HSBC that got gobbled up by RBC not too long ago, taking away competition and obviously the opportunity for Canadians to shop around with more lenders. I am totally for competition. Now, the question is do we want to see American banks in Canada? What would be the guidance? What would be the terms and the conditions? How would they abide to the Canadian regulatory situation here in Canada? These are some of the questions that I believe need to be answered. But anytime there's an opportunity for competition to help Canadians save on their mortgages and their financing goals, I think that is a fair opportunity, and we do need more competition. The one thing I will say is that maybe with the introduction, if we see these American banks enter Canada, I mean, just throwing this as a hypothetical, a lot of this conversation is just being opened up right now, with some of the banks right now actually offering a 25-year term. No, not a 25-year amortization, an actual term. So you can lock in for not 5 years, not 10 years, not 15, but 25 years. And in the US, as you know, or you may not know, the average mortgage, the most common, is a 30-year fixed mortgage, right? A 30-year mortgage, but it's on a 30-year term. So for 30 years, you know exactly what your payments are. Maybe that will be something that if American banks come into Canada, we may or may not see. Obviously, it depends on regulation. Let me know your thoughts. Would you take on a 25 or 30-year mortgage if the interest rate was right in comparison to a lower, smaller term mortgage? I mean, that is really the question. We've been having this conversation. I think it's a good conversation to have. And do you believe that American banks should be allowed to operate in Canada? Let me know your thoughts in the comments section below. I really want to hear from you. But thanks again for stopping by. Until next week, we'll see you again.